They did not just steal money, they stole retirement. Some of these schemes looked so ordinary that families signed away their future without a hint of panic, until the statements started lying back. And one of them hid inside a system no one thought could be touched. Number 10. Curtis DeYoung / American Pension Services. A retirement statement arrives in the mail and the number says, "You are still secure." In Salt Lake City, the SEC said Curtis L. DeYoung made that number fiction. He ran American Pension Services, Inc., a self-directed IRA custodian, the kind of firm trusted to hold retirement assets while customers chose alternative investments. That structure gave him control over records, movement, and custody. From at least 2005, regulators alleged DeYoung and APS squandered more than $22 million tied to self-directed IRAs and other retirement accounts. The damage was not shown honestly. The SEC said losses were hidden behind inflated account statements, leaving thousands of APS customers with balances that looked intact while the money was already gone. The case was filed on April 30th, 2014. The lesson is mechanical and brutal. False statements did not just hide losses, they bought time while retirement accounts bled. Number 9. Aequitas Capital. After advisor sold complexity comes the next disguise, a Ponzi dressed as yield. In Lake Oswego, Oregon, Aequitas Capital sold private notes and funds tied to healthcare, education, and consumer receivables. In March 2016, the SEC said Aequitas Capital Management and executives including Brian Oliver and Scott Gillis had raised more than $350 million from more than 1,500 investors. The structure had layers of jargon for one purpose: to make recycled money look like income. The paper included care payment accounts and student loan debt from Corinthian colleges, a school chain that collapsed in 2015. Many investors came through financial advisors, placing retirement savings into assets that seemed steady. But according to the SEC, Aequitas hid severe cash flow problems and used new investor money to pay earlier investors. Your dividend was a countdown with a polite label. Aequitas entered receivership and the case file turned criminal. Number 8. Provident Royalties. Here's the same pattern in oilfield clothing. You were not being sold a wildcat gamble. Provident Royalties, based in Dallas, sold fractional interests in oil and gas projects through broker-dealers, presented as steady energy income for retail investors and retirees hungry for yield. By July 2009, the SEC said the machine had pulled in more than $485 million from about 7,700 investors nationwide. The promise was production revenue. The allegation was different. New investor money was used for Ponzi-like payments to earlier investors, while proceeds were misused instead of funding the income story being sold. Complexity did the laundering. Energy deals sounded sophisticated. Broker-dealer paperwork made them feel approved. Retirement money walked in wearing trust and came out covering old obligations. Multiple executives later pleaded guilty or were convicted. The product was oil income. The fuel was new victims. Number 7. WOODBRIDGE Group. The pitch arrived as something boring enough to trust. Short-term promissory notes supposedly secured by real estate loans. If you were a retiree protecting savings, that word secured was the hook. In December 2017, the SEC moved against WOODBRIDGE Group of Companies, LLC, run by Robert H. Shapiro from Sherman Oaks, California, with another base in Boca Raton, Florida. Regulators said WOODBRIDGE raised about $1.2 billion from more than 8,400 retail investors nationwide, many of them seniors using retirement funds. The notes were sold as conservative income, backed by borrowers and property. But the SEC said the real cash flow was new investors paying old investors, while Shapiro and insiders spent lavishly. The loans did not support the promises. Investor money did. In 2019, a court ordered roughly $1 billion in judgments, and Shapiro received 25 years in prison. The security was the sales pitch. The collateral was trust. Number 6. Medical Capital Holdings. Medical receivables were the perfect fraud vehicle. They look technical, slow-moving, and hard to verify. Based in Anaheim, California, Medical Capital Holdings, Inc. and its medical provider funding entities sold notes that were supposedly backed by discounted medical receivables, meaning claims on unpaid hospital bills. Sidney Field and Joseph Lampariello pitched them as fixed income, safe, steady, and built for retirement. You were told hospitals would pay the bills down and you would collect the return. By July 2009, the SEC moved after the firm had raised about $2.2 billion from more than 700 investors. Many of them retirees and near retirees sold through independent broker-dealers and financial advisors chasing commissions. Regulators alleged misappropriation and false claims about the receivables. Receivership litigation later recovered little. The fraud hid in inflated and non-existent receivables, and complexity did the hiding. Number 5. Greater Ministries International Church. Gerald Payne stood before believers in Tampa and sold a simple promise. Put money into Greater Ministries International Church and God would double it. In the 1990s, that pitch moved through church trusts, donation envelopes, newsletters, and personal recruitment. It sounded like blessing language, but it functioned like an investment trap. Around 18,000 people joined, many of them elderly churchgoers and believers who thought they were funding something divinely approved. The danger was personal. If you trusted the ministry, you were already inside the sales funnel. New donations paid earlier participants, and those early payouts made the miracle look verified. More money followed until the fraud reached about $448 million. The biblical framing did not change the arithmetic. It only made the arithmetic harder to question. Payne was convicted in 2001 and sentenced to 27 years in prison. Trust was not collateral, it was the product. Number 4. Mutual Benefits Corporation. Worse still, this one reached roughly 29,000 investors through a product built around one variable: when insured people would pass away. Based in Fort Lauderdale, Florida, Mutual Benefits Corp sold fractional interests in viatical and life settlement policies, telling buyers they could earn predictable returns outside the stock market. In May 2004, the SEC took emergency action, alleging the company distorted policy values, life expectancy estimates, and reserve calculations, the machinery that decided whether the investment could actually pay. The scale was about $1 billion, and the retirement angle was direct. Older investors wanted stability, and the sales pitch turned that need into inventory. Joel Steinger, one of the principals, later pleaded guilty and received a 20-year prison sentence. But the next case does something even colder. It moves from selling false certainty to hollowing out an insurer from the inside. Number 3. Sholam Weiss / National Heritage Life. A judge handed Sholam Weiss 845 years. That number starts to make sense when you see what happened inside National Heritage Life Insurance Company. In the early 1990s, Weiss and Associates helped drain about $450 million through fraudulent mortgage deals and securities transactions tied to the insurer's assets. The sales pitch was not a casino floor. It was ordinary insurance and annuity products marketed to policyholders who wanted savings protection, retirement income, and predictable contracts. That is where retirees thought they were safe, and that is how the money vanished. The contracts were real, but the assets backing them were being stripped out until thousands of policyholders were left exposed when the company failed. Weiss fled the United States, was captured in Austria, and saw his sentence commuted by President Donald Trump in 2021. The vault sold receipts while it was being emptied. Number 2. Allen Stanford / Stanford International Bank. In February 2009, the SEC froze R. Allen Stanford's assets and pulled the cover off Stanford International Bank, an Antiguan operation run by a Texas financier with offices across the United States and Latin America. The bait was familiar: certificates of deposit. The kind of phrase you hear from a bank advisor and file under safe. But Stanford's pitch offered high-yield returns near 10%, far above ordinary CDs, to retirees who wanted income and principal preservation. That gap was the warning. According to the case, the money did not sit safely in a conservative bank product. It funded Stanford's businesses, his lifestyle, and earlier redemptions paid with fresh investor deposits. Roughly 18,000 people were hit for about $7 billion. Stanford was convicted in 2012 and sentenced to 110 years in prison. The cricket sponsor got a prison term longer than most lifetimes. Trust wore a blazer, then disappeared. Number 1. Bernie Madoff / Bernard L. Madoff Investment Securities. The previous scheme used offshore accounts and distance to blur the money trail. Madoff inverted the trick. He put the fraud in Manhattan, inside the Lipstick Building at 885 3rd Avenue, under the name Bernard L. Madoff Investment Securities LLC, backed by the borrowed authority of a former NASDAQ chairman. Clients were sold a steady, market-resistant, split-strike conversion option strategy. The account statements arrived like proof. If you were retired or managing a charity, a foundation, a pension-linked account, or a family trust, the numbers looked conservative and calm. But advisory clients had no real trades. They had fabricated statements engineered to show impossible consistency. By December 2008, the collapse exposed about $64.8 billion in fake balances and about $17.5 billion in direct customer principal lost. Madoff pleaded guilty in March 2009, received 150 years in federal prison, and died there in 2021. The final crime was not volatility, it was certainty, manufactured and sold until trust itself became the product.